This was a zombie EV stock for most of last year, and then overnight it turned into a hybrid proxy on Nvidia's AI supply chain. Envirotech Vehicles, ticker EVTV on Nasdaq, is a microcap that has recently traded in the low dollar range, though prices can change quickly. In this video, we're breaking down what actually happened, why the stock repriced so violently, and what needs to go right and wrong from here. Quick reminder, I'm not your financial advisor. This video is for educational and informational purposes only and is not financial advice. Penny stocks and small caps are very risky and you can lose all your money. So always do your own research or talk to a licensed professional. Until very recently, Envirotech Vehicles was a struggling commercial EV company. Its core business focused on electric trucks and vans, primarily for last-mile delivery and specialty fleet use. Like many small EV manufacturers, EVTV faced high production costs, intense competition, and persistent capital constraints. Revenues were limited, losses were ongoing, and the balance sheet carried meaningful debt. Over the prior year, the stock had collapsed more than 90%, trading at levels that often precede reverse splits or delisting risk. That context matters, because none of the recent price action is about electric vehicles. The investment narrative shifted when EVTV announced a proposed reverse merger with a private company, called AZIO AI. In practical terms, EVTV is becoming a public shell for an AI infrastructure business. And the market is now valuing the stock largely on what AZIO AI contributes to the combined entity. According to company disclosures, AZIO AI has a roughly $107 million contract with a government entity in Southeast Asia. The agreement covers 256 high-end Nvidia Blackwell generation GPUs, likely delivered as fully integrated server systems rather than bare chips. These accelerators are designed for large-scale model training and sovereign AI infrastructure. That disclosure acted as the catalyst for the repricing. Company filings indicate the contract is expected to include a 30% upfront deposit, representing roughly $30+ million in near-term cash. On its own, that deposit would exceed EVTV's historical annual revenue by a wide margin. AZIO has also referenced prior deliveries of similar hardware, supporting the view that this is not a first-time execution effort. Once this information reached the market, the reaction was swift. The stock gapped up, traded hundreds of millions of shares in a single session, and briefly pushed toward the reference valuation outlined in the merger framework. This was not a gradual re-rating, but a rapid reset of both the shareholder base and market expectations. At the center of the thesis is the merger framework itself. The non-binding agreement references a transaction value equivalent to roughly $3 per EVTV share. That level has become a psychological anchor for the stock. Below it, traders see an arbitrage-style discount for deal risk. Near it, participants begin to question how much upside remains without additional confirmation. It's critical to emphasize that this remains a framework, not a definitive agreement. The transaction is subject to due diligence, final documentation, regulatory considerations, and shareholder approval. If the deal does not close, the market is unlikely to continue valuing EVTV as an AI infrastructure company. To understand the upside case, it's necessary to understand AZIO AI itself. AZIO AI is a spin-out from AZIO Corporation, a Los Angeles-based hardware company founded in the mid-2000s. Historically, AZIO was known for high-end peripherals and consumer hardware, which at first glance appears unrelated to AI. However, the more relevant asset is not branding, but long-standing supply chain relationships. For more than 2 decades, AZIO built manufacturing, sourcing, and logistics ties across Taiwan and broader Asia. In today's AI hardware market, access often matters more than innovation. Nvidia's most advanced GPUs are heavily allocated, and new entrants without established relationships frequently struggle to secure supply at scale. AZIO AI's strategy is built around navigating that constraint. Rather than designing proprietary servers, AZIO AI appears to operate as an integrator and distributor. The model likely involves sourcing systems from established OEMs, installing Nvidia GPUs, and delivering turnkey compute infrastructure to customers. In this case, the primary customers are governments. The demand driver behind this model is what's commonly referred to as sovereign AI. Sovereign AI reflects national efforts to build domestic AI compute infrastructure rather than relying on U.S. hyperscalers or foreign cloud providers. Governments are focused on data sovereignty, national security, and control over critical digital infrastructure. Southeast Asia, in particular, is a region where digital demand is growing rapidly while local hyperscale capacity remains limited. For these governments, spending $100 million or more on domestic AI compute is not evaluated the same way a private enterprise would assess capital expenditures. Jurisdictional control and independence often outweigh cost considerations. That dynamic creates an opening for specialized infrastructure providers that can move quickly and manage regional logistics. This is the core bull case. If AZIO AI can reliably source restricted hardware, comply with export regulations, and deliver systems on schedule, the addressable opportunity is substantial. The company has also referenced a broader regional pipeline that could materially exceed the initial $107 million contract. If even a portion of that pipeline converts, revenue could scale quickly relative to the current market capitalization. But this is where the risks begin to compound. First, deal risk. The merger is not yet final. If due diligence uncovers issues, financing falls apart, or shareholders vote against key proposals, the transaction could collapse. In that scenario, EVTV would likely revert to being valued as a distressed EV manufacturer. Second, execution and financing risk. Even with a deposit, fulfilling a $107 million hardware order requires precise timing and significant working capital. Delays in customer payment, supplier allocation, or logistics could push revenue out or pressure margins. Additional capital raises are likely, introducing dilution risk. Third, regulatory risk. High-end AI GPUs are subject to U.S. export controls. As of early 2026, Southeast Asia is generally permissible, but it is also viewed as a potential transshipment risk region. Any regulatory concerns around NDUs or diversion could halt shipments entirely. A single denied export license could undermine the revenue thesis. Finally, market structure risk. Recent trading has been dominated by momentum participants. Volume levels suggest the entire float turned over multiple times in a single session, increasing the potential for sharp moves in both directions. Without new fundamental confirmation, price stability is not assured. From a chart and valuation perspective, the stock is now in a discovery phase. Prior technical levels from EVTV's EV-focused history are less relevant. Instead, traders are anchoring to deal-related reference points, gap levels, and psychological round numbers. Volatility remains extremely elevated as expectations continue to reset. So who might this setup actually be for? This is not a traditional long-term compounder story, at least not yet. It is a speculative, event-driven situation that may appeal to experienced traders or investors comfortable underwriting binary outcomes. Deal completion versus failure, execution versus delay, approval versus denial. The thesis ultimately rests on confidence in AZIO AI's supply chain, credibility, regulatory compliance, and ability to scale under public market scrutiny. Investors seeking predictable cash flows, stable balance sheets, or low volatility would likely find this unsuitable. To wrap it up, Envirotech Vehicles has undergone one of the most dramatic narrative shifts in the recent microcap market. The stock is no longer about electric vans, it's about whether a newly merged AI infrastructure business can deliver scarce Nvidia hardware to sovereign customers at scale. The upside case hinges on execution and deal closure. The downside case hinges on how quickly confidence unwinds if something breaks. Both outcomes are plausible, which is why volatility remains so high. If you found this deep dive helpful, hit like, subscribe to Penny Stock Pulse, and turn on notifications so you don't miss the next under-the-radar breakdown. Thanks for watching, and I'll see you in the next video.